Today we will talk about cash flow forecast. The learning objectives for today are, first of all, we need to know what is meant by cash flow forecast. And then we will move ahead to how a cash flow forecast is made. And obviously, yes, we want to know why is it important. In business studies course, everything that you study, it will be automatically required from you to learn about the importance of something and to learn about how to criticize something. Secondly, we will move uh, to learn how a cash flow forecast is completed or how to change our cash flow forecast. We will do it by looking at a cash flow forecast, and we will learn about how it is constructed, how it can be changed, and how to complete it if there is something missing. And lastly, we will learn about how to interpret. So if there is a cash flow forecast in front of you, how would you interpret it? How would you reach some conclusions? And why do you want to interpret it? To make a decision. Always remember, this business studies course is for to make you good managers. This business studies course has the whole focus on developing decision-making skills in you so that you are able to be successful managers. So this is purely a concept for the managers, and in particular, the finance managers who prepare the forecasts and then they make the decisions. So moving on to the next slide. Okay, the cash flow forecast, let's break down cash flow and forecast. Cash flow means, no, we learned about it, cash inflows and outflows, both are cash flows. And forecast means the future likely position or the estimated cash balance, as you said. So overall, when we are to define this term, we will say that's a statement. Number one, that's a statement, like a report. Okay, so it's not something we are doing in our mind. We write it down. That's why we call it a statement. And it shows this expected cash balance at the end of every month. So that's our cash flow forecast. Even if you forget, just look at the word, it explains itself. Forecast is about future, forecasted, estimated. Cash flow is the cash balance. So did you understand this point? So some more points about cash flow forecast. Number one, there is no specific format. There's not a fixed way to do it. You can make it in any format you want. We will follow a very simple plus and minus format. Secondly, it is prepared for the managers. It's not prepared for the investors or customers. Managers, they use it. Why they want to use it? So that they can make some arrangements. What do we mean by arrangements? Sometimes you might figure out that, okay, fine, the next month my cash would be negative. I will have a cash shortage. If you know it already in advance, then you can make some arrangements. You can talk to your bank and you can ask your bank to arrange a loan for you, a short-term loan. We also call it overdraft. And we can also negotiate with the managers to give us some low interest rates on the loan. Thirdly, the cash flow forecast is prepared on the monthly basis, like January, February, March, April, May, June. Usually it is made on the monthly basis so that we can figure out what are our monthly cash needs. So how do we make cash flow forecast? This is one of the things, it's based on market research. So market research is getting to know things about your customers, about the economy, and you figure out, okay, my inflows, you figure out the amount of your inflows, and you figure out how much money you will be spending. So it's based on market research or your past experience with a business. So at the end, it's just a forecast, and there are no guarantees that if you have estimated you will have 10,000 at the end of the next month, it's not a guarantee, because we know that and we have studied that the environment changes, just like this COVID-19. And this COVID-19, this event has changed the forecasts of nearly all of the businesses, right? So we cannot guarantee. So to sum up this concept, again, cash flow forecast is number one, a statement. Number two, it gives you estimated cash balance at the end of every month. It is prepared on monthly basis. Managers use it, and it's based on market research, and it's just a forecast. We cannot completely rely on this. There is no guarantee. Okay, if you have understood, please raise your hand, or if you have any question, please ask me. So the formula that the cash flow forecast is based on, it's very simple, and it's common sense. So if, for example, I want to know about my expected cash balance at the end of every month, I want to know about it. What I need to find out is, first I need to know my cash inflows. Remember, Everything is predicted. Everything is estimated. So I will first write my cash inflows, then I will minus my cash outflows, obviously, and I will then add any opening cash balance that I think it would be with me at the start of the month. So opening cash balance is something that you already have. So simply cash inflows minus cash outflows plus opening cash balance. This will give you estimated cash balance at the end of every month. We can also call it closing cash balance. I will write it for you here. Okay. We can also call it closing cash balance. And remember, whenever you go to the next month, your closing cash balance will become the opening cash balance. Again, if it confuses you, when we will do it, you will understand it better. For now, what I wanted to tell you was what's the main formula behind the cash flow forecast. So you need three things for every month: cash inflows, cash outflows, and your opening cash balance. And remember, everything is forecasted. Everything is predicted, right? Any question? A cash flow forecast looks like this. See, it's a statement. It's a simple statement where we are adding and minusing different numbers. And if you focus, that's prepared on monthly basis for Jan, for Feb, and for March. Okay. So first of all, what we do is we write the cash inflows. So we have cash inflows, 35,000, 45,000, 50,000. Remember, cash inflows were revenues, cash from the revenues, like you said, for a school, the fee that students pay, those are cash inflows. Or perhaps you have sold a non-current asset and you have received cash, or you expect to receive cash in a specific month. That every number will come under this heading, cash inflows. So once you have cash inflows, you write it down. Cash outflows are then subtracted. So we will minus 30,000, 65,000, 40,000. Okay. When we minus it, we will get something, but I will talk about it later. And the third thing in our formula was opening bank balance. So this 10,000 is opening, which means that, let's say we started our business on Jan, 10,000 was the money that we expect. 10,000 is the money that we expect we will have at the start of January. That's why we call it opening bank balance. So what I'm going to do is I will add it to get my expected cash balance that I expect to have at the end of January. So this is simply how you can make a cash flow forecast. Now, what I'm going to do is in the next month, I will transfer this amount as the opening balance to the next month. Similarly, I have 45,000 cash inflows. I will minus the cash outflows, right? And then I will add my opening balance. That was the closing balance in the previous month. This way, I will get negative 5,000. These brackets mean it's a negative amount. So when you have a negative amount, it means that there is a problem. There is an issue. You expect to have a cash shortage in February. Okay. In March, we follow the same thing: 50,000 cash inflows, 40,000 cash outflows. We will minus it, and we will add up the opening balance. Now, we have to think about it that it's already negative. Even if we add it, it will be subtracted automatically. These brackets, they mean you have to minus it. So once you do 50,000 minus 40,000 minus 5,000, you will get the expected balance. So again, the same formula: cash inflows minus cash outflows and adding the opening balance. And remember, the opening balance of every month is the closing balance of the previous month. And at least you need to have the opening balance of 1 month at least, right? Now we will talk about net cash flow. It's very simple. Net cash flow is a figure that you get when you minus these two amounts only. So my net cash flow here is 35,000 minus 30,000. Net cash flow of February is 45,000 minus 65,000. And the same for March is 50,000 minus 40,000. So these are my net cash flow figures. Okay, here I have minus 20,000 because clearly you see cash outflows are more and cash inflows are less. And in every other month, we have positive net cash flow. So this is how you make a cash flow forecast. Don't worry, in your examinations, they will not ask you to make one, but what they do is they give you the same table with some missing figures. Maybe this is missing, or maybe this is missing. Then you have to find out the missing figure. And the second type of questions are where you have to interpret You have to come to a conclusion. You have to give a comment, or you have to propose some solutions. How can we overcome the cash shortage? For example, we have a problem here in February, but we don't have any problems in January or in March. No problems at all. We have positive cash. Here we have a problem. If we don't have money, again, we know that if we run out of cash, what happens? Or we may get a surprise 5,000 negative. We need money. We will run towards the bank, and the bank will take benefit of it. They will charge us high interest rates. And we know that paying interest is haram. So we as Muslims, we never move to such options. But again, as a in a business studies course, as a whole approach, as a traditional way people do business, they do that, and they have to suffer from it if they don't prepare themselves in advance. Okay, that was about how a cash flow is prepared and how a cash flow is, how estimated cash balance is calculated. Yeah. Cash flow forecast is a technique that helps us to save ourselves from cash shortages and helps us to prepare in advance. We know that. Managers use it. Yes, perfect. But now we need to analyze this concept. We need to know the positives and the negatives of the cash flow forecasting. Okay. So first of all, we will talk about the new business. The new businesses, they obviously they are new, and they have to spend a lot of money on machines, on furniture, on nearly everything. There's a big investment that they're doing. So there is a big risk that they will face a cash shortage. So when you are a new business, you avoid failure. How? You avoid failure by making a cash flow forecast. And if you see that there is a negative cash balance in any of the months, you prepare yourself in advance. Either you attract new investor to put money in, or you talk to the bank that we will be needing an overdraft in a specific month, or an interest-free loan possibly, so that they can save themselves from the interest expense. Secondly, we want to convince the banks sometimes for the loans. In order to grow, we need loans sometimes. So if you want to convince the bank will ask you, how are you going to repay us? So what you do is you show them the cash flow forecast. You tell them this is how we prepared the cash flow forecast. And we expect that in these months, we will receive the cash amount, and we will have positive balances in the later months. So this is a tool, one of the tools to convince the banks to give loans to the businesses. So when you have loans, what's the benefit? You can grow. And when you can grow, you can make more profits possibly and generate more revenues. Okay. Sometimes you have to convince the investors as well by not just the idea. They ask you for a complete business plan. And as a part of business plan, you give them also, you mentioned your cash flow forecasts. And it's one of the ways you can convince them to invest with you so that you can grow. And we have talked about the cash shortages already. Cash flow forecast tells you about the cash shortages. Like we were looking at the example in February, we were expecting a cash shortage of 5,000. So if we say that we already know that we are expecting a cash shortage, again, we can go to the bank, we can talk to them, and we can get a low interest overdraft facility. This way we can minimize the interest expense. Sometimes you have too much cash balance. Too much cash balance is also a problem. It's not wise to keep a lot of cash with you. You can invest it somewhere. You can plan to make short-term investments and earn extra money that can give you a support in your business and increase your profits. So these are the positive points. You need to remember the main, the keywords like new business, convincing banks, convincing investors, when there's a cash shortage, arrangements, and if there's too much cash balance, what to do. And the negative side, which is also used as evaluation, when it's the way when you criticize a concept, that is counted as evaluation sometimes. And again, it's very obvious that your forecasts, they become useless when there are changes in the environment. So the simple reason for this is when we say the business environment is dynamic, it is ever changing, it changes. The COVID-19 is an event that is a very good example of an unexpected event. Many businesses, they are facing decline in their incomes, and their forecasts, they have to be changed. They are useless now because of COVID. But what's the best possible way to overcome this? What should we do to overcome this problem? The best possible way is when you see that your environment is changing. Now, again, I'm also giving you a clue how to show your evaluation skills. The best possible way is you keep an eye on the environment. Whenever there are changes, you do your research again and you change your forecasts. It's a big mistake when managers, they stick to the forecasts, when they stick to what they have done already. So that's the best possible way to overcome the uselessness of forecasts. At the end, we also discussed that the market, it's based on market research. We discussed that. So if it's based on market research, and we know that sometimes the market research is also inaccurate. If my market research is inaccurate, my forecasts will be inaccurate. And as a result, the decision I'm taking is going to be wrong decisions. Let's say my forecasts, they are, I can say I was very lenient making my forecasts. I forecasted my sales way too higher than they are actually happening. So if my forecasts are way too higher than the reality, there can be a problem. I can make a decision of investing my surplus cash somewhere, and then surprisingly, I might face a situation where I'm out of cash. So if my research is inaccurate, if my past experience is very less, there can be problems in the forecast. So the best possible solution for this is my market research must be accurate, and I can consult the expert researchers, or I can get reports from specialist agencies before my forecasts, or I can talk to the expert people to make forecasts for me so that I can minimize the problems of inaccuracies. So these are the positives and the negative sides. If there's any question, you can ask me. Yep. Boom. Boom. Okay. Cash flow forecast. To recap, cash flow forecast is estimated. It's a report that gives you estimated cash for every month. It is prepared on monthly basis, used by the managers. The formula is cash flows, inflows minus cash outflows plus opening cash balance. This will give you the closing cash balance. And closing cash balance for every month is the opening for the next month. Who uses the cash flow forecasts? The managers. What are the use and limitations? We just covered that part. The cash flow forecast, you can convince banks, you can convince investors. It's